Hello everyone, welcome back to our channel and welcome back to this video. In this video, we wanted to share with you a quick update on the global bond reset. The real yields are breaking out, the energy inflation is hardening, and the bond vigilantes are framing returns from UK to Tokyo. What the allocators should be pricing in. Let's do a deep dive and let's try and find out. The mid-May sell-off across the developed market sovereigns is not a duration tantrum looking for a narrative. It's the bond market that's repricing two things at once, a supply-driven energy shock that the West Asia conflict is unlikely to resolve quickly, and the fiscal trajectories that look increasingly exposed in a higher real rate regime. The combination is what gives this particular episode its character. Rates are rising not because the growth is accelerating, but because inflation is sticky and the marginal sovereign buyer is asking harder questions about the issuance. The benchmark US 10-year touched a one-year high on Friday, 2 sessions after the 30-year auction cleared at the highest yield since 2007. Real yields led the move with tips pushing back above 2%. This matters more than the nominal headline. A rising real yield with inflation expectations anchored is the bond market telling the Fed that it does not believe that a cut is imminent, and the next move, if anything, is the other way. So let's try and understand this in terms of the cross-asset implications. First and foremost, you have the equities. The US indices made fresh highs into Thursday on AI-driven momentum and then gave back 1 to 2% as bond signals finally priced through. The disconnect between the equities beta and the rate tape has been the defining feature of post-March recovery. Friday is the first session in weeks wherein rates regime forced equities to reprice. Multiple compression risk is now asymmetric. Real yields above 2% with energy reaccelerating leaves little cushion for a momentum-led tape. And when we're talking about the credit, higher real yields and a fatter term premium tighten conditions for corporates without an immediate distress signal. Herein, watch the private credit complex first. Semi-liquid BDC structures have absorbed the early stress. Floating rate book NAVs benefit at the coupon line, while the underlying credits face refinancing math that gets worse the longer real rates stay here. And then we have the FX. Dollar strength against low yielders is the path of least resistance until either the Fed signals a pause is durable or energy rolls over. The JGB yields at record highs change the trade structurally because the long USD Japan carry that has financed risk for years is now contested at the Bank of Japan end. The emerging markets crossed with energy import exposure remain the most vulnerable cohort. And then we have the commodities. Brent at above $109 is no longer a tail. It's a working assumption. The secondary effect, that's the sticky goods inflation feeding into services via the wages, is what bond markets are now discounting and what makes the Fed on-hold scenario the new base case. Let's also try and briefly understand the sovereign stress map. When we're talking about United Kingdom, we see gilt yields at multi-decade highs with political risk now compounding the fiscal arithmetic. Local election losses have escalated pressure on the Prime Minister and introduced a leadership change scenario into the rates curve. Sterling assets carry the highest discount rate at the G7 cohort right now. Moving on to Japan, the wholesale inflation surprised to the upside. JGB yields hit record territory and Bank of Japan policy normalization has moved from a debated thesis to a positioning reality. The implication for the global rates is structural out here because the largest exporter of duration to the world is becoming a buyer of its own paper at higher levels. And then we have the Eurozone. The Italian 10-year is up 11 basis points to 3.89%. Bunds are up at 3.12%. Spread behavior remains orderly, but the absolute level of the yields is now what matters for the periphery debt sustainability. Watch the BTP to Bunds spread for the first sign that the move is becoming credit-driven rather than rate-driven. And finally, let's discuss United States because next year's 20-year auction is the next live test of demand depth after a string of soft prints. A weak tail there would shift the conversation from real yields to term premium and put fiscal sustainability on the front page of US markets coverage for the first time since 2023. So in effect, what can be said is the signal is not duration pricing. It's the regime in which sovereign issuance is being asked to compete for capital on real yield terms, and the bid is conditional, not automatic. Next, let's turn our attention and try and understand what is it? Is it vigilantes or is it energy? The bond vigilante framing has returned to the mainstream commentary, but the diagnosis is incomplete. The acute driver this week is energy because Brent at 109 forces every central bank to confirm that the policy stays restrictive and forces every sovereign issuer to fund at higher levels. The chronic driver, the one that gives Vigilante narrative its purchase, is the slow accumulation of deficits across G7 that, in a 2% real yield world, no longer trades like background noise. The United Kingdom is where the two stories overlap the most. Japan is where the chronic story is becoming acute via Bank of Japan normalization. The United States is where the chronic story remains latent but now is 1 week auction away from becoming explicit. So, in closing, what we can say is that the vigilantes are not yet on the prowl in any coordinated sense, but the conditions that would activate them are tightening in three sovereigns simultaneously. Now, that's all that we wanted to share with you in this brief video update. Stay tuned in for our next episode.